In this video, I'm gonna show you the exact system that I use to help traders stop resetting prop firm accounts and start withdrawing consistently. And I know this works because I've helped several traders stop doing this, go from literally can't pass the accounts to literally getting $700 payouts, to getting $4,500 in a day, getting $1,000 payouts, getting $4,900 payouts, and getting consistent payouts from one firm, literally just on a consistent basis. So in this video, I'm gonna show you why you keep failing these payout windows, what's actually breaking your accounts, and actually how to fix this step by step. So let's break down why most traders never get consistent payouts. This starts with this thing that I call the I can't loop, right? So most people think that it's actually the skill that's basically the problem, that you can't actually do something, when in reality there's a constraint that we need to address, and that constraint is I can't, right? So common I can't statements are: I can't stop over leveraging, I can't keep profits, I can't stay consistent, I do good and then I give it all back, right? I always mess up right before payouts, right? Most traders think that these indicate a discipline problem, right? But in reality, this is actually a systems issue, right? So there's three systems that I specifically use, right, in order to actually help me and other traders get payouts trading futures. So let's get into the three pillars of what I use, right? The first one I want to talk about is the drawdown protocol, the drawdown control protocol, the DCP, the execution model that I use, and I use the strat, by the way, and then the success protocol, right? So when you combine all of these together, you literally can just build yourself up and actually win. So let's get into the first one, which is going to be the DCP, right? So drawdown control protocol is basically a risk management protocol that I've used. The purpose of the system is to solve the over leveraging and then the managing drawdown issue that you might be having, whether that you're trading on your personal account or whether you're trading on an evaluation stage or a funded stage using a prop firm, right? So this is the trading strategy that I literally use for personal accounts when it comes to trading my personal accounts, evaluation stage, and the funding stage. So when it comes, I mainly trade MEQ, MES, or NQ and ES, right? Those are the main ones that I'm using. My bad. Those are the main ones that I'm using. And I like to trade other ones too, but those are the main ones that I like to trade, and I have my risk management specifically tailored to those when it comes to my personal account, right? But I like to risk 5 to 10% of margin per trade when I'm risking on my personal account. So as an example, right, if I'm using, for example, 10% margin, that means I'm using 10% of the actual account balance. So let's say my account is at $10,000, right? If I'm using 10% of that, 10% margin, right, I'm using $1,000. So if I'm taking a trade, I'm leveraging $1,000 to take that trade. And when I leverage that $1,000 to take that trade, I'm always risking maximum 50% of the margin that I am using, right? So if I use 10% of my account, let's say I have a $10,000 account, and let's actually draw that out real quick. Let's say I have a 10K account, and then let's just say I use 10% of it, so I use 1K, right? The maximum that I'm willing to risk on that is gonna be 50% of that. So whatever half of like 1K is, which is $500. So for me, every trade that I take, I'm risking roughly half of the margin that I'm using. So I'm roughly risking 5% of my account per trade that I'm taking on my personal account. And that's just the way that I like to do it personally because of my strategy and how I'm good with managing my risk, and also just taking high quality trades that end up going in my favor. This is the risk management that works for me, right? So when it comes to the evaluation stage, this is how I like to do it. I like to risk, for max daily loss, I like to risk 1/3 of that max drawdown. So let's just lay it out real quick. I actually have notes right here. Let's just say that I'm trading a 150K account, right? My max loss that I can take on that account is $4,500, but the profit target is $9,000. So what I'll do is I'll risk 1/3 of that max drawdown in order, and then from there, let's say, so what that looks like, 1/6 of max drawdown for this type of account in terms of per day would be $1,500. So my max daily loss is $1,500. My max trade loss, like the max loss that I take per trade, is gonna be 1/6 of that drawdown. So that's roughly $750. And you don't have to do this math on a daily basis. You can literally do this one time and then just know this for every trade that you take. So you can put those risk management risk management in place on the broker that you're using. You can literally go into the system for, if you're using like Top Step or like Project X, or you're using TraderBait, you can go in there and set how much you allow yourself to risk on a trade by trade basis or on a daily basis. So if I were you, I would go into your account and literally say, all right, what is 1/3 of my total max drawdown that I can take on my prop firm? So if it's 4,500, what is 1/3 of that? So if you divide it by 3, it's 1,500. So in your settings, you can literally put, all right, bet, I don't want to take no bigger loss than $1,500 today. And then you'll be consistent with that, because that means that you literally have to lose $1,500 3 days in a row to blow the account, right? If you're trading your strategy the way you're supposed to trade it, and you're taking high quality trades and you letting them go, especially if you're trading the strat, this will not be an issue for you, and this hasn't been an issue for me or my students, right? When it comes to the funding stage, I like to decrease the risk even further. So instead of risking 1/3 of my max drawdown for per day for the evaluation stage, on the funding stage, I'm only risking 1/5. So for example, if I have my max drawdown is $4,500, right? I'm only gonna risk $900 per day when I'm starting out on an account, because again, the focus for all of these is going to be capital preservation. If you do not have capital preservation, you will not be able to manage your accounts properly. But this is the way that I manage my risk across all of the accounts, and it is different because the purpose of each account is different. My purpose on my personal account is to compound. The purpose of the evaluation account is to obviously pass them and then actually get the funded account. And then the purpose of the funded account is to maintain it and then compound that account so that the payouts that I can get are bigger, right? So that's the way that I manage all of them. But let's go into each of these real quick. I told you the objective already, pass the account without over leveraging it to do that. And then once you get above the buffer and you also get your first initial payouts, the next goal is to maintain the account, and then after that, get more accounts. Because the more accounts that you get, you scale them slowly, you'll get bigger payouts with more accounts. Because if I have 5 50K accounts and I can only withdraw 2K from one, and I had only one originally, if I get a 2K payout, bet, take that capital, reinvest that back into getting 4 more, and then I stack those together, and then I can get a 10K payout just from connecting, group trading 5 different funded accounts together, right? And then eventually you take that profit and then you put that into your personal account, and then you use that to actually compound. And I actually probably drop a video below where I talk about, I have a blueprint specifically for scaling and growing your capital. And I think that video will be very beneficial for you. So make sure you check that out after that. So yeah, that's basically how I manage my risk. Now, when it comes to my strategy specifically, most people know the simplest strategy that I have found, right? Especially for futures, is the strat, right? Now, again, anybody can use your own strategy, but this is just what has worked for me. And I've been trading the futures for about 4 years now, trading options for 5 years, literally half a decade in. The best strategy that I have traded, and I've traded like 16, 17, the best one has been the strat for me, right? The first thing I want to talk about is actionable signals. So the principles of actionable signals is this. They give a clear moment where the market tells you what to do, right? And I use them to enter and exit trades. So for example, if it takes out the high, right, that is a bullish continuation or a bullish reversal. If it takes out a previous low, right, that is a bearish continuation or a bearish reversal, right? So literally, if you just look at this cheat sheet right here and just look at these as candles, right, a bullish continuation is when it takes out the previous high of this candle. So on a candle by candle basis, this takes out the previous high, right? This bullish reversal, this candle takes out the previous high. So whether it's continuing higher or reversing higher, I'm able to know the characteristic of what the market is doing in a very specific way that doesn't change. Because you can pull up a chart right now with candlestick charts, you will not see any other candle except ones which are inside bars, right, where price is consolidating, where it doesn't take out a high or a low. A 2, which is a directional bar, where it takes out only one side, right? And then the 3, which is an outside bar, which takes out both sides of the previous candle. These 1, 2s, and 3s combine to create something called actionable signals. And that is literally all that I use to enter and exit trades. Now, the second component of my strategy is called time frame continuity. And if you stick around to this, because I know this seems like a lot, I'll actually show you when you combine all of these together, what type of trades you can take in the market if you actually implement them the right way, right? The principles of time frame continuity, if more than one time frame are going in one direction, you can be more confident that price will keep continuing in that direction. More is greater than less. So the more aggressiveness from buyers than there are sellers, price is gonna go up. More aggressiveness there is from sellers than buyers, right? Price is gonna go down. This is an example. We have a 2-2 continuation on the monthly, 2-2 bullish pattern on the weekly, 2-2 bullish pattern on the daily. And then we have I don't know if this is a 2 or a 3, because I can't see the previous candle, but let's say this is a 2 down, inside bar, 2 up. This is a bullish reversal to the upside with continuity going up on the month, week, and day, right? So combining all of that together, you're able to take trades alongside of the big money that's pouring a lot of money on the monthly time frame or the weekly and the daily time frame to take a high quality trade, right? The next thing and the last thing that I use to combine and wrap everything up with the strat is called broadening formations. And this is very simple, right? This is a little bit trickier to execute and stuff like that because, you know, most traders trade differently. Some people use the bigger time frames, some of the smaller, but the principle of the broad information is very simple. Fact number one, sellers like to sell stuff at a high. If you buy a MacBook for $1,000, if you could sell it for $5,000, you definitely would because you want to sell it at a higher price and make more money, right? Facts number two, buyers like to buy stuff for a low price. If you can get them J's for $100 from the store and then you can resell them for like $200, $250 because you got the, dang, I've been out the shoe game for a minute, but if you get the Jordan 11 Jubilees or something like that, right? And you get those for 100, you flip them for like 200, 150, something like that. Their goal is you want to buy stuff for a low price, buy real things for a low price, valuable things for a low price, right? When you combine both of these facts together, you get something called a phenomenon where it just keeps happening over and over and over again. And that phenomenon is called higher highs and lower lows. Because sellers like to sell stuff at the high, right? Because sellers like to sell stuff at a high and buyers like to buy stuff at a low, whenever there is a new high created, right, or a new low created, sellers like to step in at the high, buyers like to step in at the low, and it creates this pattern where we have higher highs, sellers step into the market being aggressive, push price down, buyers load up at lower prices and then push price back higher, and that is the rhythm that the market likes to move in, right? And that's basically what I teach, even on my YouTube and stuff like that. I think I have another video also on that kind of talks about like how they trade the broad information and stuff like that, and I think that video will also be helpful for you as well. But yes, so that's why that is all the components that I use of the strat, and I'm taking forever to erase this thing. But these are all the three principles. When you combine these three together, right? Reversal for or continuing, actionable signals, 3 or more time frames that are green or red, that's time frame continuity, and then higher high, lower low, repeat, broad informations. Combining these principles together, if you look at this trade on silver, if you leveraged $1,000, for example, on this trade, and you took this to the upside, you're risking $1,000 on this trade, and then that trade goes for $3,500 when you enter and just exit with actionable signals. If you just enter to exit with actual signals, there's ways that you could take profit and scale out and all that stuff, but just keeping it simple. This is a 2 down, 2 up reversal, right? I'm gonna go to the actual signal sheet. This is a 2 down, 2 up reversal. You enter when price takes out the high of this previous 2 down. If I go back to this chart, we take out a previous low, that's the high, we take that out. That is a bullish reversal. Everybody that was previously selling on this candle has to now exit. And that is why price shoots up so fast. Everybody that was previously selling here, if you were selling here and then price starts reversing against you, what do you got to do as a seller? Exit. What do you have to do as a buyer? You just keep letting that thing fly. So if you got in here risking $1,000 on this trade, literally you risk $1,000, you could have made $3,500 on that trade if you exited on a 2-2 reversal back down. Because this is a 2 down, 2 up bullish reversal. This is a 2 up, 2 down bearish reversal. Right? Price is reversing higher, price is reversing lower. You're using specific, repeatable, actionable signals to enter this trade. And you're also doing this with continuity because at that time, because this was 7 o'clock, there was a new hourly candle that opened up and price was also bullish on that hour, right? So, and this is also broad information, as you can see. We have, right, as you can see, we had a lower low, higher high, lower low, higher high, right? And that pattern literally took place, and you could have made $3,500 on that trade. If you risked $475 on this trade, this was a 2 down inside bar, 2 up reversal, right? With continuity, because this flipped at 6 o'clock. So that means that the higher time frame, one of the higher time frames, is bullish, going in your favor. So that is a bullish actionable signal with continuity, right? After taking out a previous low. So we take out a low, then we go and take out a high. You risk $475, you make $4,000 on that trade, right? And then here's one more example where if you risk $2,700 on this trade, for example, you would have made $25,000 on that trade. And then eventually, once price starts going in your favor, you could just, start protecting yourself on the downside. But again, at that point, these lines that you see on my chart, these represent different time frames. This blue line represents the daily. This light blue line represents the hourly. When price was reversing below that, that means that the daily is bearish, and below this light blue line, that means that the hourly is also bearish. So you're taking this bearish actual signal, a 2 up, 2 down reversal with bearish full time frame continuity to the downside. After taking out a previous high, sellers step into the market, push price down, and now buyers want to step into the market at the bottom. That was a $25,000 trade, risking $2,700. So if you risked $270, you made $2,500 just by combining all of these principles together, right? And that is how powerful the strat is, but also how simple it can be when you have the right structure and you really understand how to trade this. The last thing I want to talk about is the success protocol. These are the scaling rules that I have. And the mindset behind this is you should trade when it comes to the outcome of any trade. There's only 4 types of outcomes you should be optimizing for, right? So on your personal account, I want to make sure, I forgot to change this too. I'm tripping. But what I meant to say for these was you should be optimizing for a small loss, right? You should be optimizing for a break-even trade, right? You should also be optimizing next for a small win. And then the last thing you should be optimizing for is a big win, right? So you might be thinking, well, okay, well, what does that mean? Notice how on this list, I don't have big loss anywhere. So right now, if you've been trading and you've been taking big losses in the market, there is a problem, because that should not be in your set of rules or things that you're focusing, or not focusing on, but like doing a part of your strategy. You should literally have things in place that don't allow you to take big losses, whether that's taking a lot of small losses or taking one big loss. That should not be a part of your strategy whatsoever. And with the success protocol, I basically kind of optimize myself to be able to do that. So let's get into basically how do we achieve this outcome in the market, right? The first thing, micros first, and then you transition into the minis, right? I see so many people do this. They want to jump to the NASDAQ mini contract, like the NQ and the ES, but they don't want to be on the MNQ and the MES because they want to be on the bigger ones and stuff like that. And it's I get it, but it doesn't matter. Like the fees and stuff like that, when you're going from micros to minis and stuff like that, because there's a point where you might as well just trade NASDAQ. When you're just if you're using 60, 70, 80 contracts or something like that, okay, maybe you can start trading, with the NQs and stuff like that. But if you're only trading 2 NQs or something like that, you might as well just keep trading the micros and then just scale up, because it allows you to take those smaller profits and stuff like that as you start going, and then you can leave runners on your position. How many of you, for example, have taken a trade and you only had one NQ contract, and then you didn't take profit on a trade, right? And then it went against you. Or you took profit on a trade, but then it kept going, but you didn't have any more contracts to leave as runners, right? That is an issue that stems up when you don't have enough contracts to start taking profit on, because you'll end up just taking one big loss instead of taking a small win, and then when price comes back against you, take a small loss, and that ends up being either a break-even trade or a small win. And that might seem small to some people, but that is very powerful when those things stack up over time. The next one, size only increases after. You have the consistency, you adhere to your rules, meaning you follow your rules, and then you have proof that you've gotten a payout before, right? So a lot of my students, right, when it comes to consistency and stuff like that, right, Like one of my students, for example, I forgot who it was. Yeah. So this came like literally. I'm gonna read this out. First half of the year was brutal, and now it's looking nothing like it started. So there was literally like she was not, because I blurred out her name because she didn't want to be talked about and stuff like that, like be revealed, you know what I'm saying? But she literally had talked about this before, and she talked about it with me, like just having the issues and stuff like that in the beginning of the year, mainly pertaining to like the psychology and stuff like that of trading and just passing the account and maintaining it. But literally after, like she just been having a crazy shift. But now she's at this point, she's gotten I think 7 to 8 payouts now. After this video has been uploaded, this was in December 2025. But yeah, so up until this point, she had already gotten multiple payouts at this point because she made that shift. She had to prove to herself that, let me get this payout first. Let me just get this one payout to show myself that I can actually get this done and do this. And then once I do that, I study what I did to get there, and then I do it again, and then again, and then again. And that allows you to be consistent and show up in the market the way that you need to show up. Right? But again, she started sizing heavier on some of the trades that she's taken. And then she even got to a point where she's taking a $10,000 trade in a day because she was able to size into the position, hold it, and let the trade run based on the strat. And she was able to hit a $10,000 trade, right? But that came from the small discipline of just building up consistently, right? And that's what most people avoid. Now, number 3, scaling is earned, not forced. So this goes back to what I was talking about. You need to earn the right to scale up contracts, scale up your account. You need to earn that. And how do you specifically earn that? You need to put in the work, right? Scaling is a system. It's not a feeling that you kind of act upon and just, oh, I feel like I should just scale. I feel like I should be more confident here. I feel like I should be making more money. No, your account will show that, right? After you basically keep showing up and you keep doing what you're supposed to do with your account and building it up, your account will show you. You'll be getting payouts. You'll be getting $10,000 payouts. You'll be getting $5,000 payouts. You'll be getting $1,000, $2,000 payouts in the market because the market rewards good behavior repeated over time. So if you're taking good trades over time and not taking as many bad ones, the market rewards that. It's systematic. It's not like an emotional thing like we are. It's very systematic and it's calculated, right? So you need to make sure that you're following that to be able to do that. And I can't, show this and stuff like that because I teach this in my mentorship, but like this is the process. If you're literally optimizing, the first thing you should be doing when you're taking a trade is optimizing for a small loss. Always. You should always be optimizing for a small loss. I know some people, the first thing they're looking for is how much can I make? The first thing that I say when I'm taking a trade is how little can I lose? Like think about that, write that down real quick. Whenever you're taking a trade, think to yourself, how little can I lose on this trade? If you optimize for that, and you take high quality trades that you can lose a little bit on, if they lose, so what? You lost a little. But if they work, guess what? You're making a pretty decent amount, and then that compounds over time to the point where you can now, that little bit you were risking before, let's just say it was $100, that $100 now can start to be $200, and then it can start to be $300, and then it can start to be $400, and then it can start to be $500, because now you've compounded your account, whether it's prop firm or personal, where you've gotten to a point where that small loss or that small loss for you is a little bit different. Because again, 10%, watch this, 10% of a $1,000 account is $100. But 10% of a $100,000 account, if I'm not mistaken, no, 10% of a $10,000, that's crazy. 10% of a $10,000 account is 1%. 10% of a $100,000 account is 0.1%. I think 0.1%. But again, that $100, it's not the $100 that's changing. It's the account size connected to what you're actually risking and what's considered small based on your account balance. So like I said before, you have to earn it. So the way you earn it is by optimizing for it in the beginning. Optimize for a small loss. Then focus on making sure that you get a break-even trade. So many people, okay, I gotta get on camera for this one. Bro, a break-even trade is a win. I see so many people online, so many gurus that be like, bro, like I hate breaking even trade. I just want to win. I just want to get that small win and stuff like that. I hate just breaking even. Breaking even is a win. And the reason I say that is this. The one thing that you're guaranteed to do as a trader is lose. There's a higher chance that you will lose every trade, right, than it is for you to win every trade, right? Because watch this, nobody trading, right, that's been trading consistently over a long period of time or a decent enough time, right, has 100% win rate. They've lost something. Warren Buffett has lost something, right? freaking Charlie Munger has lost something, right? People have lost, and that's okay. They've lost millions, to the tune of millions and billions of dollars. They've lost. Losing is a part of trading, right? So winning is not guaranteed in this market, because if winning was guaranteed, then that means that some people would have a 100% win rate over a consistent amount of time, and that just don't happen. People lose. So if the one thing that's guaranteed to happen is going to happen, then you need to optimize for that thing. If that thing is lost, then you need to make sure you have a small one. You need to make sure that you're not losing. And guess what? A break-even trade is not a loss. You made money. So if you put your stop loss, right, slightly above where you entered and stuff like that, or slightly below where you entered if you're in sales, right, to make sure that you make back whatever you spent in commissions and stuff like that, and maybe a little bit more than that if you want to, then guess what? That's a win, because you didn't lose. Capital in your account that's kept in your account is a win, because you can then redeploy that later on. But if you lose the whole account, you can't redeploy anything. Your ammo, right, is the capital that's in your account. So when you keep it, that is a win. So I want you to reframe how you think about break-even trades, because you can take a break. Now, if you take a break-even trade and you don't take any winning trades you're supposed to take, and then you keep taking small losses, you will bury your account alive gradually over time. So you still need to optimize for break-even and then re-entering high-quality trades, which is the next part that I'll talk about, which is optimizing for small wins, right? You need to, after you optimize for a small loss, after you optimize for making sure you break even on your trade, then the next thing you should look for is a small win. And then after that, once you optimize for these things, there will be a day that will come where you will have the ability to hit a big win in the market. And that big win will look something like, for example, because all these were different. This one was $3,500. This one was $4,000. This one happened with one contract, by the way, was a $25,000 trade, risking $2,700 on that trade, right? So you will eventually get to a point where, because again, you didn't have to do anything. You just had to enter this trade and then hold it, because it went 2 down, 2 down, 2 down, 2 down, 2 down. Did it reverse up at all? Did it do an actionable signal? Because this is a bullish actionable signal. 2 down, inside bar, 2 up. It took out the previous candle's high. Based on these previous highs, did it take out any of those highs? Mark out the high, mark out the high, mark out the high, mark out the high, mark out the high. It didn't take out any of those highs. So since it didn't take out any of those highs, then you can keep holding that trade. So this is how you create big wins. You follow your strategy, you optimize for a small loss, break even, small win, big win trade, and then eventually that's what's gonna allow you to position yourself to take big wins in the market. So again, the secret to scaling is simple, like literally simply asking yourself, what are the simple things that I can do to guarantee my success in trading? And then the second thing is, how can I hold myself accountable to consistently doing those things in the market? And again, the answer to that is, again, using the game I just showed you how. The key is getting your first or your next payouts going forward, right? Once you get those payouts, once you prove to yourself that you can do it, once you show yourself like, okay, I think I really got this. I think I understand this a little bit now. That will help you, right, get to the point where you can start scaling and compounding your account and then building yourself up to be able to start getting consistent payouts in the market. And you'll be able to create a system for it. And you can do this with any prop firm, and then you can connect them together, and then you can even take bigger payouts from there. So I hope this video was helpful for you guys. Let me know if you have any questions, stuff like that, drop that in the comment section. And I'll also link together another video in the description or somewhere here, something like that. And I think it'll be a follow-up to this, because I know there was a lot in here. I wanted to follow this up with another video that I think will be really helpful for you guys. So I'll make sure you watch that when I upload it. And yeah, I'll see y'all later. Let's get it.